Tonight's lecture, guys, I did a whole lot of the basics before tonight. I'm going to be doing a whole lot of more advanced stuff tonight. So I've done the basics with you. I've done basics on shares. I've done basics on like interest. I've done basics on Forex. I'm going to do some of the harder topics and also some of the newer topics tonight. And I'm also going to do a little bit of revision with you on what I did with you last week. Okay, so first things first, section 24J. We did accrual of interest last week, and we went through the basic principles. And what happened was, as far as accrual of interest is concerned, okay, what needed to happen, guys? It says you get a deduction if you're the borrower or the issuer. So I'm looking at this part of it. It said you can deduct interest derived from the carrying on of a trade, provided it is incurred in the production of income. Guys, comfortable? And that was in 24J. And we said there's a problem with that. Okay? The problem is normally when we buy shares, we receive dividends. When we receive a dividend, we include that dividend into gross income. And that dividend is exempt from income. So normally if we take out a loan to buy shares, can we get a deduction on that loan interest? And the answer is no. Everybody comfortable with that? So normally with shares, I take out a loan to buy shares for investment purposes. Dividend included in gross income, but exempt, no income, no deduction. If I was a share dealer, it wouldn't be a problem. Does everybody understand? Because for a share dealer, I buy the shares, you get a stock deduction. Purchases deduction. I sell the shares, it goes into my gross income. So we're talking about investments. We're not talking about share dealers here. Guys, comfortable? So overall principle, cannot claim when we buy investment shares and we take out a loan. So what happens, guys, is there's section 24.0, which actually comes back to this chapter, chapter 11.2.2. And section 24.0, basically, if you want to just write down something on the top of the page, this overrules, okay, in the production of income requirement. So in certain circumstances, the in production of income requirement is overruled. So this one overrules it. So guys, 24 big O in your cycle legislation handbooks. I'm going to go past the definitions to start. I just want to go into subsection 2. And guys, inside subsection 2, what subsection 2 does. Sorry, just let me get there. Where I'm circling it. Over there. Can you see it says be deemed to have been incurred in the production of income of that company and laid out or expended by that company for the purposes of trade. Does everybody see that? And it's got the word be deemed at the beginning. So guys, what are they saying? We are going to overrule section 24J. 24J says you can't claim it, but in certain circumstances, we can get a deduction for interest if section 24.0 overrules it. So 24.0 will overrule it. Is that all right? So it says be deemed to be in the production of income and laid out for the purposes of trade. Are you guys comfortable with that? When are they going to overrule it? Let's look a little bit higher up in subsection 2. It says, subject to subsection 3, where during any year of assessment, any interest is incurred by a company in respect of a debt issued, assumed, or used by that company. So any debt issued, so basically there's interest payable. And then it says, for the purpose of financing the acquisition in terms of an acquisition transaction. Do you guys see the word acquisition transaction there? Okay. And it says, later on, that company held that equity share. Now, guys, what's an equity share? We're going to see that term a lot today. What is an equity share? So voting share that shares in profits of the company. So essentially not necessarily voting when they define it for tax. They define it as a share that shares in the profits of the company. So it gets ordinary dividends. Are you guys comfortable with that? So participating pref would actually be an equity share as well. Okay? But ordinary shares. Everybody comfortable? And then it uses the term that constitutes a qualifying interest in an operating company. Does everybody see that? So basically we're saying if there's an acquisition transaction in a operating company, we will be able to claim the interest as a deduction. And where those definitions are a little bit higher up. So let's have a look at those definitions now, and I'm going to go through and I'm going to summarize it for you now. So guys, it says acquisition transaction means it needs to be in an operating company, as a result of which, at the end of that transaction, that company is a controlling group company. Now, does anybody know what controlling group company means? It means 70% or more. So if you were to go back to the definition, and it's in section 1 of the Act, it says that you need to own 70% or more of a company. So guys, an acquisition transaction, you need to be owning 70% or more of the company. Are you guys comfortable with that? And then if you look at the definition of operating company, it says that at least 80% of the aggregate amount received by the company, okay, must constitute income in the hands of the company. So guys, and it says it needs to come from a business carried on continuously by that company, in the course of or furtherance of which goods or services are provided or rendered to the company for consideration. So essentially, if you're looking at that definition of an operating company, number one, 80% needs to go into income. Okay? So you can't have like an investment company that just gets dividends. Does everybody understand that? Because then 80% is not going to be income. It's going to be exempt from income. So you're looking at a trading company. Everybody comfortable with that? And it says from a business carried on continuously by the taxpayer, you need to be trading continuously. Everybody happy? And it says in the course or furtherance of which goods or services are provided. So you either need to provide services or goods. Everybody comfortable with that? So you're going to need to tag it, and I'm going to issue with the tag sheet, but I want you to actually just understand where we're coming from tonight. So if I go back into the notes and I have a look at the notes, look what's going to happen, guys. It says, when a taxpayer purchases shares in the company for capital intention and takes out a loan to purchase those shares, the interest incurred is normally not tax deductible. Guys, comfortable with that principle? This is due to the fact that local dividends earned are exempt from income. So let's look at the example. It says A Limited purchased shares as an investment for 100 and took out a loan to purchase such shares. Dividends of 12 were earned during the year and interest of 8 was paid on the loan. What are the tax implications? So 12 in gross income. But the 12R is exempt, which leaves income of 0, which means that the 8,000 interest is not allowed as a deduction. So there we come to section 24O now. So section 24O overrides section 24J and allows a deduction for interest when acquiring shares in certain circumstances. It says section 24O2 deems interest to be incurred in the production of income whilst carrying on a trade and thus deductible. So do you guys see that? It said it's deemed if equity shares are required. So only for ordinary shares. It's not for prefs. It's got to be shares that share in profits. 2, this is an acquisition transaction. So when we looked at the definition of acquisition transaction, what does that mean? 70% holding or more in the same group of companies. So either you or one of the companies in your group owns 70% of the shares in that company. Okay? And it needs to be in an operating company. So for an operating company, what does that mean? 80% of the amount received constitutes income from a business carried on continuously by that company for goods or services. Is that all right? So there's your summary. Okay. Now, if that's the case, it overrules it. So let me show you what a question looks like. So I've written a question for you. Okay, and this is how it would get asked in an exam. Now, guys, I need you to understand the way that we're going to answer this question, and I'm going to get you to read it now, is that the first thing you're going to do is you're going to do 24J. And let me explain why. And I just want to go through your overall approach. So when you did test 2, The approach should have been as follows. The way the Act works, it says, is there a sundry, is there a specific section that deals with this? And for interest, is there a specific section? 24J. So what are you going to do? The first thing you're going to do is you're going to apply section 24J, because that's the way the Tax Act works. It says if there's a specific section, you use the specific section. So when we do the solution to this question, you will do 24J first. Are you guys comfortable? If the specific section doesn't work, that's when you go to the general deduction formula. So immediately the 24J is not going to work, and it's not going to work in the example you're about to read. You will go to general deduction formula, and you're going to have the same problem. Why are you going to have the same problem? Because it also has got the term in the production of income. And you're going to have the same problem. And then what's going to happen, you can go to 24O, which is the overrule section. Does everybody understand that? And because 24J doesn't work and general deduction formula doesn't work, we can use the overrule section, which is 24O. Are you guys comfortable with how the solution will be structured before we look at a solution? And normally this would be about a 15 marker in a year-end exam. This got asked 2 years ago in the year-end exam for 4862. It hasn't really been part of the 4861 syllabus, but it is part of the syllabus this year. And if you look at the 4861 TAT letter, it's treated as a new development. So I would imagine if I was a 4861 student that this is very, very important for year-end exam or something along those lines. There have also been some changes to the definition of operating company and acquisition transaction. So for 4862, this is a new development. And what tends to happen in your exams and in your board exams? Wherever there are changes, they tend to ask it. So this I would treat as a very, very important section for year-end exam. Class test, maybe, I don't know. Year-end exam, very, very important. So I would imagine a year-end exam question work a little bit like this. So it says, you're the financial director of Edge Limited, a medium-sized private company that manufactures condoms. Edge Limited has a February year-end. The company has a number of government contracts that they've successfully tendered for after their major competitor handed out free condoms that did not work properly because they stapled the safe sex brochure to the condom. Do you remember that happening? True life story. A couple of years ago. Yeah. The managing director became aware of acquiring a company called Pretty Pty Limited that is trading at a substantial discount because of losses, but has tremendous long-term business potential. Now that's telling you it's a capital transaction. Now remember, 24O is only needed when it's capital. If it's a revenue transaction, if it's share dealing, you'll get the deduction anyway. You don't need 24O. So it's telling you long-term potential. He's inquired about the transaction. He's considering Edge Limited buying and holding this investment for a period of at least 5 years. Capital. The company is considering acquiring 85% of Pretty Pty Limited. That's good, because what do we need to own? At least 70%. Okay? It says, a company that specializes in manufacturing computer parts and accessories. The trading stock is then sold 88% to SA customers and 12% to neighboring countries. Now, guys, that 80% rule applies to all sales. So 100% of their sales come from sale of goods and services. We're actually allowed to have 20% that's investment income that's exempt, because the Act says 80% of their turnover. In this case, it's 100%. Does everybody understand? That 12% to neighboring countries is irrelevant. It still goes into gross income. Are you guys comfortable with that? Okay. It says the purchase price for the shares is 1.7 million. This will be financed by a loan from a bank at a rate of 12% per annum, repayable monthly over a period of 5 years. The expected date of the transaction will be 1 December 2016. Discuss supported by calculations the deductibility of interest paid by Edge Limited on the 1.7 million loan for the 2017 tax year. So it's issued on 1 December. The year end is February. Everybody comfortable? Now, I think it's important that you just see how the solution is structured. Because if you've seen one of these questions, they all start looking identical. Does everybody understand? So it says purchase of shares, number 1. It says there's no deduction upon acquiring shares that are intended to be held for capital purposes. Are you guys comfortable with that? This is an investment transaction. We need to say, listen, we're buying shares, no deduction. It's held for capital purposes. Interest now, guys, we must calculate the interest. So it's your choice as to how you want to do it. But PV 1.7 million minus future value 0. I is equal to 12% divided by 12. It's calculated monthly, 1% a month. Number of months, 60 months it's being paid over. Compute payment. Once you've got your payment, you can do your amort calc. I've done the formula as if it was on an HP calculator. Alternatively, guys, if you want to, you can do the table at the bottom. Your choice. Either way, you'll get the same answer. Is that all right? So, answer interest is 53,745. Guys, comfortable with that? So there'll be some marks for the calc. Okay, discussion of 24J. Do you understand why we start there? There's a specific section, we need to deal with it. It says the shares are acquired as a long-term investment for the purpose of earning dividend income. Dividend income is exempt from gross income protection 10(1)(k). Interest incurred is thus not incurred in the production of income. No deduction may be claimed in terms of section 24J as the section requires the production of income. Are you guys comfortable with this? Happy? Now, guys, I've done it shorter because it's only out of 15, okay? If this question was out of 25, I would have defined what an instrument was and whether it's an income instrument and all of that stuff. But because of the mark plan, I've restricted the discussion. Do you guys understand? If you've got a very big mark plan, like 20 marks or 25 marks, you would go into the definition of what it says inside the Act. But we're dealing with lots of sections here. General deduction. So similarly, cannot be deducted in terms of general deduction formulas. It must be in the production of income. Section 23F specifically prohibits the deduction of any amounts that are not included in income. Guys, comfortable? So can't use those two. 24O. Says section 24O requires that a company acquired must be an operating company purchased via an acquisition transaction. DP2I Limited is an operating company that carries on business continuously for the provision of goods that are sold. Because it says you need to sell goods or services and you need to operate continuously. That was part of it. Pretty Limited was acquired via an acquisition transaction as it was in an operating company as defined. And Edge Limited is a controlling group company as it owns 85% of the shares. And I've got their notes. You need 70%. Guys, comfortable with that? Okay, carrying on. Because section 24O applies, the interest is deemed to be incurred in the production of income, laid out for the purposes of trade, and incurred in respect to amount received by accrued to the company that constitutes income. Because that's what section 24O does. It deems the following to be there, and the interest will be deductible. Guys, comfortable with it? This is cool. So if you get one of these, it should look like this. Do you guys understand it's always going to look like this? You're just going to have to see, is it more than a 70, is it 70% or more? Do we get at least 80% of our turnover from selling goods or services? Okay. Do we trade continuously? Okay. If that's the case, then we'll be okay. If that's not the case, then we're not going to be okay. We're not going to be able to get the deduction. Are you guys comfortable with this? So that's 24O. Yep. It's fine. That's where I would set it out if I was doing a financial calculator with workings and everything. Is that all right? Otherwise, the table. So that's why I did both for you. Okay. So that's 24O. Do you guys understand what's going to happen with 24O? Generally, it has to be like a little 15 marker, 12 to 15 marker. And it would look a little bit like this. Are you guys comfortable? I think there's one question inside the 4862 assignments with a 24O in the middle of the exam question from 2 years ago. 4861, I don't think you've got one in your assignment, but here's a question for you. Are you guys comfortable with this? Okay.